Gentlemen, after going through every single page of BlackRock's latest filings and data, I found something very interesting. Usually they buy everything and stick with the big names, such as the Magnificent Seven. But recently, they've been selectively piling a heavy load of money into some very specific and smaller companies. And as you all know, BlackRock isn't just another fund. It's the money manager that sits behind huge portions of the market with the highest win rate and highest return. So I gathered for you these 7 small cap stocks that BlackRock is heavily buying right now. And when you look at these names individually, they might just look a little risky. But when you look at them together, a clear theme emerges. It's a bet on the infrastructure of the future, from AI power grids to battlefield technology. So let's cut to the chase and walk through these 7 stocks one by one, what they do, why BlackRock might want exposure, and exactly how much BlackRock increased. And stay with me, because the last one is the most extreme. BlackRock increased its stake by over 165%, nearly tripling its position. Now let's get into the list. Stock number 7, Lucid Group, LCID. Lucid is an EV maker known for premium electric sedans, very high efficiency, and a brand that's still trying to prove it can scale beyond early adopters. It's a stock the market has punished heavily because EV demand has been uneven, pricing pressure has been intense, and scaling manufacturing is expensive. BlackRock's 2026 outlook prioritizes targeted exposure to structural megaforces like energy transition and high-end industrial technology, where Lucid's best-in-class efficiency and backing from Saudi Arabia's Public Investment Fund, PIF, provide a unique, long-dated growth profile amidst broader market dispersion. The stock is currently trading around low teens, but BlackRock's double down and Uber's newest investment in the company for robotaxi purposes might signal a huge potential upside for Lucid. BlackRock made an additional increase in Lucid and pushed its position to a record high, filed Feb 13, 2026, adjusted to approximately 5.6 million shares following a 1-for-10 reverse split. Stock number 6, Archer Aviation, ACHR. Archer is an eVTOL company, electric vertical takeoff and landing, basically the air taxi dream, short hop flights in and around major cities. This is one of those categories where the story is huge, but the timeline is everything. The market typically punishes eVTOL names when certification timelines slip, and rewards them when milestones get cleared, because the entire valuation rests on moving from prototype to real commercial operations. BlackRock increased its Archer stake by over 7 million shares, bringing its total to almost 53 million shares, a pleasant 16.77% increase, owning over 8% of the company, filed Jan 21, 2026. What does that suggest? At minimum, it suggests Archer is staying in the institutional future transportation basket, and ownership is not fading. The catalyst path here is straightforward. Certification progress, production ramp readiness, partnerships that signal real routes and utilization, and any evidence that unit economics could work once fleets scale. This is high volatility exposure, but it fits a pattern. Institutions often want optionality in categories that can become winner-take-most if the technology and regulation align. Stock number 5, Bloom Energy, BE. Bloom Energy sits in a different bucket. It's not a moonshot flyer in the same way. Bloom is about power, often discussed through the lens of fuel cells, on-site energy, and reliability. And that matters in 2026 because the market is increasingly obsessed with one constraint: electricity. AI data centers, industrial electrification, and grid stress are pushing investors to look for power solutions that are scalable and deployable. BlackRock increased its Bloom Energy stake by over 4 million shares, bringing the total to over 22 million shares, a pleasant 22.66% increase, filed Jan 21, 2026. This kind of ad is the type of position that makes sense for a giant allocator because it's a way to express energy infrastructure and power reliability without buying a pure commodity bet. BlackRock emphasizes pipes and power, the essential hardware and energy required to sustain AI data centers, positioning Bloom as a derivative AI trade that provides immediate grid-independent power solutions. Stock number 4, Astera Labs, A-Lab. Astera Labs is one of the cleanest AI infrastructure picks and shovels stories in public markets. When people think AI, they think chips like NVIDIA, but the real bottleneck often becomes connectivity, moving data fast and reliably inside servers and across data center racks. That's where Astera sits. It's tied to the plumbing that helps AI infrastructure scale. BlackRock increased its Astera Labs stake by 2 million shares, bringing the total to over 10 million shares, a plus 25.80% increase filed Jan 21, 2026. BlackRock's systematic strategy favors Alab's debt-free balance sheet and its recent move to profitability in Q4 2025, viewing the company's software-defined architecture and new Scorpio X-Series platform as essential pipes and power for the next phase of AI scaling. Stock number 3, Oric Pharmaceuticals, Oric. Oric is a clinical stage biotech focused on oncology, with an emphasis on overcoming resistance mechanisms, basically trying to make cancer therapies work better and longer. Biotech ads from big institutions can look strange because revenue isn't the story, data is. In biotech, a single clinical update can reprice a stock more than years of normal business execution would. BlackRock increased its Oric position by almost 2 million shares, bringing the total to 5 million shares, marking a 51.18% increase filed Jan 21, 2026. A 51% increase is not a casual adjustment. It suggests Oric remains firmly in the high upside innovation exposure bucket. BlackRock is positioning for a catalyst-rich 2026 as Oric initiates its first global Phase 3 registrational trial for its lead prostate cancer candidate, Oric 944, in the first half of the year. This investment aligns with BlackRock's broader 2026 outlook, prioritizing selective risk in biotech, specifically favoring companies like Oric that possess a fortress cash position of $413 million, providing an operational runway into 2028, and strategic validation through high-tier partnerships with Pfizer and Johnson & Johnson. Stock number 2, Red Cat Holdings, RCAT. Red Cat is one of the most on-theme ads in your list for 2026. Drones and defense technology. Modern conflicts and modern military doctrine are increasingly shaped by drones. Reconnaissance, targeting, short-range tactical operations, and cost-effective force multiplication. The market has been repricing defense tech away from only the old primes and towards smaller companies that can actually ship systems that match current battlefield needs. BlackRock increased its Red Cat stake by almost 4 million shares, bringing the total to about 9 million shares, a 73.68% increase filed Jan 21, 2026. A 74% jump is big, and it makes intuitive sense. Drones are one of the fastest growing categories inside defense procurement, and there's also a national push toward domestic supply chains and certified systems. What you watch here is contract momentum, production scaling, and whether Red Cat becomes embedded in longer-term procurement cycles instead of one-off orders. If that transition happens, the market often starts valuing these names less like speculative tech and more like defense supplier, which tends to support higher multiples. BlackRock's systematic model favors Red Cat's selection for the U.S. Army's Short-Range Reconnaissance (SRR) program, which is projected to drive revenue from $41 million in 2025 to $143 million by the end of 2026. This targeted exposure allows BlackRock to capture high-margin growth in autonomous defense systems and digital infrastructure, while the company maintains a fortress cash balance of over $200 million to fund its rapid production scale-up. Now we get to the last one, the biggest increase by far. Stock number 1, Bitmine Immersion Technologies, BMNR. This is the one that jumps off the page. BlackRock increased its BMNR position by over 5 million shares, bringing the total to almost 10 million shares, a plus 165.60% increase, filed Feb 12, 2026. That is not a small change. That's a near tripling of the stake. Bitmine sits at the intersection of two things institutions can't ignore anymore: crypto market structure and crypto infrastructure. Whether you love or hate crypto, big allocators increasingly treat it as a volatility asset class with recurring cycles, and they want exposure to the infrastructure layer, not just the coins. Despite Bitmine's recent $5.2 billion Q1 2026 net loss, driven by a crash in ETH prices, BlackRock's systematic active equity model views the company's 4.33 million ETH treasury, representing 3.58% of the total supply, as an institutional grade vault that circumvents direct crypto compliance barriers while offering massive price elasticity for an eventual recovery. Finally, I want to say that the common thread is this. These are all areas where the market can re-rate quickly once the next piece of evidence drops. BlackRock increasing exposure doesn't promise a winner, but it does tell you where capital is getting positioned before the story becomes consensus. Thank you for watching. I'm Professor Portfolio, and please drop a like and subscribe if you find this helpful. Until next video.